Hello and welcome to another episode of Property Ponderings, the podcast where we dig deep into the world of property buying and renovating, giving you property advice to ponder. I'm Craig Nichol from Nichol Buyer Advisory here in Melbourne, Australia, and I'm here to turn your property dreams into a reality. With over 15 years of experience spanning everything from town planning, sales, auctioneering, property investing, and buyers advocacy, I've gained insights into every corner of the property world. Today we're diving into auction clearance rates, what they actually mean, why experts make such a big deal about them, and how you can use them to gauge market conditions and make smarter buying decisions. By the end of this episode, you'll understand what these figures really tell you about the property market and how you can use them to time your moves effectively. So let's get started. So what are auction clearance rates? Auction clearance rates are the percentage of properties listed for auction that successfully sell either at the scheduled auction time or shortly after on that day. They're calculated by dividing the number of successful sales by the total number of auctions held. For example, if 100 homes went under the hammer last weekend and 70 sold, the clearance rates would be 70%. Clearance rates are one of the most closely watched indicators in the property market, particularly in cities like Melbourne and Sydney, where auctions are a dominant sales method. Experts often use them as a barometer of market health, but what do they actually tell us? Clearance rates generally fall into three broad categories, each reflecting different market conditions. So above 80% is a hot market. When clearance rates are consistently above 70%, it usually signals strong buyer demand. Sellers tend to have the upper hand and prices often trend upwards. This is what we call a seller's market. We've seen these conditions during property booms like those in 2021 when lower interest rates fueled a surge in demand. The second category is that 50% to 70%. This range is what we consider a more balanced market where supply and demand are relatively even. Buyers have more room to negotiate and price growth is generally moderate. The final category is below 50%, which we call a weak market. Clearance rates below 50% indicate that buyers are in control, often due to economic uncertainty, rising interest rates, or oversupply. This is where you're more likely to find bargains as sellers become more willing to negotiate. It's important to note that clearance rates can fluctuate seasonally, with lower rates typically seen in winter and higher rates during spring when the market is most active. Now let's talk about Melbourne and Sydney versus other cities, as I think it's a key difference to understand in interpreting clearance rates. So auction clearance rates are particularly meaningful in Melbourne and Sydney, where auctions are a dominant sales method. In these cities, over 50% of the property transactions occur via auction, giving clearance rates a statistically significant role in measuring market activity. With these percentages, they would change during hotter and cooler markets as there are less auctions in cooler markets, but it's still a very strong indicator in these major cities. In other states, such as Queensland and Tasmania, auctions are far less common, with most properties sold via private treaty. Because auctions play a smaller role, clearance rates in these areas don't offer as reliable a snapshot of the broader market. For example, in Brisbane, less than 20% of the homes are sold at auction. As a result, clearance rates there may not reflect the overall buyer sentiment as accurately as they would in Melbourne and Sydney. So why should buyers pay attention to auction clearance rates? Well, these clearance rates can be a valuable tool for buyers, helping you gauge the level of competition in the market and plan a strategy accordingly. So firstly, it allows you to potentially time your entry into the market. If clearance rates are high, you'll need to move quickly and be prepared to potentially pay a premium. Conversely, if rates are falling, you may have more time to negotiate or wait for prices to drop further. The second thing is about spotting trends. Clearance rates can be an early indicator of market shifts. For example, if rates have been consistently high but start to decline, it could signal a cooling market. The third thing that clearance rates help is assessing auction day strategies. In a hot market, you'll face more competition at auction, so it's crucial to know your budget and stick to it. In a cooler market, you may have more room to negotiate with the vendor post-auction if the property doesn't sell under the hammer. The fourth and final offering that auction clearance rates assist with is that it can help you understand local context. So clearance rates can vary significantly between suburbs. A hot inner city market might mask slower conditions in outer suburbs, so make sure you're looking at data that's relevant to your target area. So a few caveats: while auction clearance rates are useful, they're not a perfect measure. For one, not all properties are going to auction, and the type of properties being auctioned can skew the data. For example, high-end homes might have lower clearance rates due to a smaller buyer pool, even in a strong market. Additionally, clearance rates reported on a Sunday evening are often preliminary and can change as more results come in. You always have to check the final figures midweek for a more accurate picture. So when you see the results come through on a Saturday night, or you're reading the paper on the Sunday morning, just make sure that you try to account for how many auctions were meant to go and then how many results are actually shown within the paper or anything, because you'll find that sometimes, or a lot of the time I would say, if people have passed a property in, that data won't necessarily be disclosed. Some people like to keep that under wraps and then put the property to a private sale pretty quickly. So I guess with the belief that there might be a stigma to see a property in the paper or the results that says it was passed in, sort of highlighting that it potentially didn't have the interest. And so what you'll see is then the amount of auctions that have been reported in the paper to have occurred on the day would be lower, and there's less properties then that have passed in, and so potentially that auction clearance rate's higher than it should be. And I would say most of the time, depending on which publication you're looking at, the clearance rate is often higher than actually what happens, especially if you take into account that the clearance rates in the papers are including properties that have sold after the auction and not at the auction. So it's more of just a sold properties figure on the day. And so if you have a lot of properties that are being passed in but sold after auction, it's a bit of a different sale than if it was sold under competition whilst the auction was going on. So you just have to be careful about those intricacies, and remember as well that these publications like realestate.com.au and Domain are chasing agents after auction on the Saturday, and if agents don't respond, then that result isn't being reported. So the auction clearance rates, I would say, they're not always accurate, but if you do see that the reported auctions before the day were, say, it was meant to be 1,000 auctions on the day, and then most of the data has been collected with, say, 950 of the auctions reported, and you have all the data and it's showing strong clearance rates, and that's really good figures. But then if it was meant to have 1,000 auctions and 600 of them being reported, then you know that the quality of the data is a little bit lower. So just have a closer look into that to ensure that you're getting the correct picture. So in conclusion, what do clearance rates actually mean? And I think they're a valuable gauge of market conditions, particularly in auction-heavy cities like Melbourne and Sydney. Whether you're a buyer looking for an edge or a seller trying to time the market, keeping an eye on these figures can help you make smarter decisions. Just remember to look beyond the headline numbers and consider the broader context, including your specific area and property type. Alright, that ends another episode of Property Ponderings. I hope that's giving you a few small tips to make some better property buying decisions. If you want to discuss anything further from this podcast, get in touch, 0400 122081, or you can email me at craig@nicholbuyeradvisory.com.au. We'll chat again soon. Provided in this podcast for general information purposes only and does not constitute financial, legal or professional advice. While we aim to provide accurate and up-to-date information, every property transaction and investment is unique and should seek the advice of a qualified professional before making any financial decisions. The opinions expressed in this podcast are our own and are not a substitute for tailored advice from a financial advisor or a real estate professional. We encourage you to consult with a qualified expert who can address your specific needs and circumstances.